Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph Show as we continue our series on credit. And I just want to remind you, if you've missed any of these broadcasts about credit, you can go back and listen to the podcast. All of our radio shows and shows that we promote are all on podcast. So you can go to your place where you normally get your podcasts and you can just look for the Ask Ralph podcast and find all those items today. Now, last session, we talked about a credit report. Well, today we're going to talk about a credit score. And this is sometimes confusing for a lot of people. You know, being responsible with your money makes you more than a good citizen. It makes you a good credit risk as well. And when it comes time to buy a new home or a car or apply for credit, a good credit risk is exactly what the lenders will be looking for. So not only does your credit rating determine if you qualify for a loan, it also determines your credit limit, basically how much you can borrow and at what annual percentage rate that you're going to get. In other words, the better the credit score, the better the deal you may get on your loan. Now, this is sometimes a little foreign to people. You know, when I was working in the credit industry, people wouldn't understand, you know, why is my credit score what it is? So I thought I would talk about it today. What are the components of a credit score and how is that credit score determined? You may hear this also referred to as a FICO score. So whether you're applying for a car loan or a credit card from the gas station, most lenders can determine if you're credit worthy within seconds. How do they do that? Well, and if you've ever applied for a loan online, you know they'll say, okay, you've accepted your application, and you'll get a pop-up within about 30 seconds. It says whether they've accepted your loan or not. Now, you need to know that obviously there's not someone always sitting on the other end of that computer waiting for your application to come in. But what they do is they pull up your credit score, or is also known as a FICO score, like I said. That was actually named after Fair Isaac and Company, the company that developed the credit score model. And it's a 3-digit number ranging from 300 to 850. Now, this works, you know, in that the higher the score, the better your credit worthiness. So let's say you're applying for that credit card loan through the internet. And, you know, the folks at the lending side could say, okay, well, let's accept anybody who has, you know, for example, they could say, well, let's make sure they've been on their job for at least, 4 years. And then if their credit score is greater than 700, that may be an automatic approval. Now, most lenders don't look closely at your credit report. That's just the truth. Most lenders in the past, they would. You should keep a close eye on it because each of the information pieces determines what your credit score will be. And lenders are definitely taking a close look at that. For example, in the mortgage industry, most mortgage brokers will not even touch a credit score less than 640. So that's the bottom line. And only lenders with a legitimate business need can ask for your credit report, such as when you apply for a credit, buy a car, apply for a job, or rent an apartment. Now, the thing you need to know, as we talked about before, and one of the reasons you want to have good credit is a potential employer can ask for your credit report with your consent. Each of these credit reports, as we talked about in the last session, shows you, talks about the different things that are on your credit. We talked about the three major ones. That's Experian, Equifax, and TransUnion. And each of these three have a different history, and they also may have different FICO scores, and this will sometimes confuse people. Not always is a credit score a credit score. There are different predictors. For example, a lot of banks and credit unions will use a 60-day, what they call a 60-day deficiency score, which is the likelihood of this person to be deficient within or miss a payment within 60 days. Some of them may be a bankruptcy score. So let's talk about what makes up that score. And it's really this, and it's your past payment history makes up 35% of that score. So how quickly you pay your bills weighs heavily on your overall score. The more recent that you have late payments, the more points you're going to lose. And your credit report will indicate whether you're 30, 60, 90, or more late on a payment. Those late payments on several occasions cause more damage than late payments on a single account. So they're looking at the propensity of this. Now, so that's 35% of it. The other one, number two, is the amounts owed. That's 30%. If you add up all of your outstanding balances and compare the number to the amount of credit available. And we talked about this before as well. That's why you don't want to go out and charge up a credit card to its max. You want to try to keep that below 60%, because what that is going to do is that's going to affect your credit score as well. And that's a 30% part to that. Now, the length of the credit history, which is kind of surprising to me, is only a 15% share of this. Now, obviously, the longer you've had credit established, the better you'll look in the eyes of the lender. But your score is only determined about 15% about how long you've had individual accounts, as well as how long it's been since you've used that account. So one of the things it talks about when you do some research on this is don't open multiple accounts in the hopes of building credit quickly. That's going to reduce your average age of your credit report, which is going to affect that 15% part we just talked about. Now, number 4 section of your part is the amount of new credit. That's 10%. So again, a pretty good weight for new credit. Every time you apply for a credit cards or loans, that inquiry makes its way onto your credit report. Lenders take note if there have been too many inquiries on your credit report in a short period of time. And I've beat this up a lot. One of the things that you will find is lenders are really looking at that. And that's what I talked about before. If you're in the market to buy an automobile, for example, be very careful about meeting with the finance manager at each of those dealerships and putting in a credit application, because each one of those is going to reflect an inquiry. And I've had a lot of clients come into me and they've said, Ralph, I don't understand it. I went car shopping and next thing you know, I had 15 inquiries. I don't understand. How could there be 15 inquiries? I only went to 3 dealers. Well, here's the problem. So you go to dealer A. Let's say you go to a Ford dealer. So what the Ford dealer does is they're going to run that through their credit bureau. They're going to pull a credit report. And then maybe they send your loan out to 3 or 4 banks. So now you've got the one from the dealer, and now you've got, let's say, 4 banks. Well, there's 5 inquiries right there. So multiply that times 3 places that you've stopped. Now you've got 15 inquiries, and you may still not have purchased anything. But those 15 inquiries are going to affect your credit score, because they're going to use that 10% of new credit to try to figure out part of that credit score. Now, the final part of this are the types of credit. And what we're talking about here is credit cards and installment loans like car loans and your mortgage are examples of different types of credit. If you have had no credit, lenders will consider you a higher risk than someone who has managed credit cards responsibly or loans responsibly in general. So again, that's 10%. So the types of credit. So one of the things that we're going to talk about in our next session is, how do we go about improving your credit score? But we needed to understand the fundamentals of this. So remember, payment history, 35%. Amounts owed, 30%. Length of credit history, 15%. New credit, 10%. And types of credit, 10%. All of these to try to get you in, that credit score range of, 300 to, and it depends. Each of the credit bureaus have different models that they use with different scoring things. On this particular one that I'm looking at here, this Fair Isaacs model was 300 to 850. So if you ever hear somebody say, well, I've got an 800 plus credit score, it's what we in the industry would call like A paper. That's like when you were in school, if you got an A on your paper, you did pretty well. And then if you got a score below 700, maybe like a 675 to 800, that might be a B, or B paper we would call it. And then once you get down into the 640s, you might be C paper. And then when you get a little bit lower than that, you're in that D, and maybe you're not going to get a loan paper. So pay attention to your credit score. Look at your credit report, and if there's things you need to dispute, let's do that. So in our next session, we're going to talk about how to improve your FICO score.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.